Welcome back, investors, to Ticker Time News. I'm Adam, and the peak inflation narrative is in full swing following the release of the March Consumer Price Index, or CPI, and the Producer Price Index, or PPI, each shown on the screen here. The blue line is the Consumer Price Index, and the orange line is the Producer Price Index, each of which was awful from an inflation reading standpoint, which is part of why there is such a serious desire to believe that these reports are as bad as it's going to get. Is that true? Can we really be at peak inflation? And will that cause the economy to perform better? Well, first, here are the headline numbers so we're all on the same page. CPI was up 8.5% year over year, and core CPI was up 6.5% year over year. PPI was up 11.2% year over year, and core PPI was up 9.2% year over year. Now, those numbers aren't the Everest-like peak seen in the 1970s and 1980, but current inflation readings are at dangerous altitudes that haven't been visited in the case of CPI since the early 1980s. Now, I can't say for certain that we are at peak inflation, not with Russia continuing to wage war with Ukraine and China continuing to wage its war on COVID with its zero-tolerance approach. What I can say, however, is that the market should be careful about cheering peak inflation, because cheering peak inflation is unknowingly cheering a peak in the economic recovery. Now, inflation needs to come down. There's no question about it. The way it comes down and the pace at which it comes down are the unanswered questions. And to be fair, supply constraints have played a huge role in driving these enormous inflation readings. Yet there are other factors on the demand side that have contributed to the worst inflation readings in 40 years. And that would be the roughly $10 trillion combined of fiscal and monetary stimulus that led to huge increases in the money supply, huge upticks in personal savings, and huge increases in asset prices that were catalyzed by the artificial suppression of interest rates driven by quantitative easing. So here we are. Quantitative easing is now turning into quantitative tightening. Will this work? Fiscal support, outside of maybe the infrastructure bill, is fading fast. Monetary support is being pulled, but arguably not fast enough. A growing number of Fed officials seem to recognize that, and they have already begun speaking out about the idea that the Fed needs to move rapidly and take a more aggressive approach to reduce the size of its balance sheet, and that's quantitative tightening, taking money out of the market. And that's more than the Fed did during the previous recovery. Now, this understanding, combined with the base comparison math, a strengthening dollar, and the belief that the supply chain problems will keep improving, and ironically, the demand destruction that results from high inflation, is the basis for thinking that inflation readings will start to fade from their March peaks. It would be a welcome sight if, in fact, they did, but it may just be a short-lived feeling of relief given some emergent activity in the stock market that is more consistent with an outlook for much slower economic growth. Now, a picture is worth 1,000 words, right? So here's a few pictures or charts to back up the claims that something is out of sync with the narrative of a strong economic outlook. Specifically, we're going to look at the Dow Jones Transportation Average, the Philadelphia Semiconductor Index, the SPDR S&P Regional Banking ETF, and finally, the iShares U.S. Home Construction ETF. Spoiler alert, none of which are trending in a manner consistent with a feel-good attitudes about the economic outlook. All right, first up, the Dow Jones Transportation Average. Now, you can follow along right at home using TradingView. There is a link in the description for a free account. Now, the first ticker symbol for the Dow Jones Transportation Average is DJTA. Now, the Dow Jones Transportation Average is viewed as a forecast of economic growth or economic slowdown. If we're in a downtrend, then we are in a slowdown. This is a precursor to it, so a leading indicator. And this peaked on November the 2nd, 2021, and it has been in a downtrend ever since. So that's showing that the economy is slowing down. Okay, next up is the Philadelphia Semiconductor Index. Ticker symbol is SOX. Now, the Philadelphia Semiconductor Index peaked on January the 5th, 2022, and has been in a downtrend ever since. All right, next up is the SPDR S&P Regional Banking ETF. The ticker symbol is KRE. Now, the SPDR S&P Regional Banking ETF, ticker symbol KRE, it peaked on January the 14th of 2022 and has been in a downtrend ever since. And then finally, we have the iShares US Home Construction ETF, ticker symbol is ITB. Now, the iShares US Home Construction ETF had a double top here and finally peaked on January the 3rd of 2022 and has been in a downtrend ever since. Now, with all of these charts, what you'd want to see are the trend lines on the charts moving up. That would be viewed as a sign of confidence in the economic outlook. That presumably would translate into stronger earnings growth. But these current trend lines are suggesting the opposite, even though the market is presumably embracing the idea that peak inflation has already been hit. Now, this is the case most likely because the connection is also being made that the Fed is determined to use rate hikes and quantitative tightening to, quote, cure inflation. That will translate into higher market rates, which it already has done. The 30-year fixed mortgage had a bottom on January the 14th of 2021 at 2.79%. The last reading we got on the 30-year fixed rate mortgage was Thursday, April 14th, just last week, and that came in at 5%. That's an incredible run up that we haven't seen in many, many years. And what this will do is put a halt to borrowing activity and consumption before having any broader influence of reducing inflation. And to a certain extent, things are just getting started there, evidenced in part by the nation's banks disclosing increased provisions for credit losses in their first quarter earnings reports, which just happened last week. That's not good news. Banks are expecting and preparing for people to default on their loans. So, what does this all mean? From an objective standpoint, the March CPI and the PPI reports were downright terrible. There was nothing to cheer for them, except maybe if you were thinking about buying a used car, because that did tick down a little. But when things are as bad as those inflation reports suggested, the market likes to think that things can't get any worse. Now, that could be true here, but with the war effort in Ukraine getting bogged down and the reported logistics supply chain problems in China stemming from the lockdowns that stopped the spread of COVID, there's no guarantee that things are going to get significantly better anytime soon. The Fed, however, now sees a target on the back of inflation. And that's the only way the Fed can see it, because the Fed has been running behind inflation for far too long. The Fed should have raised rates last year in 2021, but they didn't. The Fed will now be playing catch up with aggressive policies. And as it does, the inflation rate is likely to take a step down, but so will the economy. And that's the catch-22 of our current situation. Rising interest rates, which are necessary to get inflation under control, will also slow the economy down. So cheering peak inflation is just like cheering the arrival of slower economic growth, which brings slower earnings growth, which brings slower earnings multiples, and in simple terms, will bring the stock market down too. And to that end, peak inflation is more bad news than good news right now. What do you think? Are we at peak inflation? And what's going to happen with the economy? Let me know in the comments below, as your comments help us all to better understand this mess we're all in together. If you could, help us out by smashing that like button, sharing this video, and beat the market with us by clicking the first link in the description, and that also helps out the channel. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.